what do you think about the valuations I showed just a moment ago? If you type ECSU on the Bloomberg terminal, you see economic surprises, and they continue to come out to the downside.
Yeah, look, we're in this period where bad is good for multiples, right? So slower growth, as long as it's not a recession, brings down inflation expectations, which allows the Fed to cut. And that's what the market has been anticipating now for almost a year. Now, they've been wrong about the number of cuts, but the conclusion the equity market is making right now is that, well, there's not going to be a hike. And we know the direction of travel is down. And that's fine so long as that negative growth surprise doesn't turn into a hard landing. And right now, that's not the case. Now, the labor market is showing signs of weakness, but not to the degree that would freak out equity markets. And so what's going on is the markets are very efficient right now. They're basically putting money to work in high quality growth stocks. They're paying up for anything that has growth because that's what the market needs. Growth is scarce. So people are saying, well, the market should broaden out. It's not going to broaden out if this continues, but it also doesn't mean that we're going to collapse until there's either evidence that we're going to have a hard landing or there's evidence that we're going to reaccelerate and then the Fed can't cut and rates go higher. So we're stuck. We're stuck in this sort of environment that really a lot of active managers don't like because it's narrow, it's hard to pick stocks again, and it's hard to outperform.
Hard to outperform. It sounds like what you're saying, though, is that at the benchmark level, that narrow breadth, it doesn't necessarily mean that returns will be way down.
No, not necessarily. And we did some work on this the last couple of weeks that shows that when breadth is this bad, and by the way, it's historically bad, it's a 50-50 chance that it's bad, and it's 50-50 chance that it's good for the overall S&P 500 index. And so we play this game until it ends. And the game will change. The question is it going to be a situation where you have everything gets corrected lower, or can it broaden out to small caps, to more cyclical stocks, to other assets that don't have a multiple 40 or 50 times?
Mike, you've written recently also that investors are increasingly becoming concerned about higher rates, perhaps even a rate hike down the corner. You look at this year and expectations for September, for example, but then you look on a longer horizon and the worries about fiscal spending here, spending from either a future Biden administration or a future Trump administration. How much worry do investors really have under the surface, and how could that throw the entire storyline off course?
Right now, that concern is not there. Okay, and the way we measure that concern is the term premium. So rates have gone up this year from January, and it didn't affect the overall market multiples because it was not about term premium, meaning concern about fiscal sort of spending. It was about growth being better and, quite frankly, inflation being better. Now, there's a misnomer out there that higher inflation is bad for stocks. Not true. Higher inflation is good for smaller stocks. It's good for the average stock. What we have right now is we have a disinflationary boom, which really means that the few stocks benefit. So I don't think it's a risk now, but with our election, with the elections overseas that are going on, and more importantly, just the fiscal spending that's going on regardless of the outcome of the elections, I think it could come back into play later this year.